Porsche was supposed to be one of the safest bets in the entire automotive industry. Instead, something has gone seriously wrong. For the second time in just 14 months, Porsche has been forced to pull back from its plans. And this time, the message is coming from inside the company itself. This isn't a temporary delay. It isn't a careful adjustment. It's a major retreat. Porsche is turning back toward gasoline-powered cars after betting heavily on an electric future. And the financial numbers explain why. In 2024, Porsche reported an operating profit of around $5.6 billion. Just 1 year later, that figure had crashed to roughly $413 million. That's a staggering 93% drop in only 12 months. And the damage becomes even harder to ignore when you look specifically at the car business. Porsche's automotive division saw its operating profit plunge by about 98%, leaving it with only around $90 million. For a company known for enormous margins and some of the most desirable cars on Earth, that is an extraordinary collapse. But Porsche didn't stop there. The company has announced thousands of additional job cuts as it tries to reduce costs and deal with weakening demand. Then came another major signal. One of Porsche's flagship SUVs is no longer being treated as an electric-only project. A hybrid sedan has also been pushed out of the company's plans. Piece by piece, Porsche is changing direction. And that's what makes this story so fascinating. A brand that once appeared perfectly positioned for the future is now being forced to reconsider some of the biggest decisions it made only a few years ago. So how did Porsche go from being one of the industry's safest success stories to becoming a warning sign for the entire automotive world? To understand that, we have to go back to Porsche's position just 4 years ago, when the future looked very different. Porsche once looked almost impossible to break. In 2022, it was one of the most profitable car companies in the world. Porsche sold about 309,000 vehicles and made roughly $6.8 billion in operating profit, with a margin close to 18%. In an industry where 8% is considered healthy, Porsche was making extraordinary money from every car it sold. And it was doing it without Toyota-sized sales numbers. That same year, Porsche pulled off something almost unthinkable. It separated from Volkswagen and went public, raising $25 million at a valuation of nearly 75 billion euros. For a short time, Porsche was worth more than the parent company that still owned most of it. This was a brand that had survived oil crises, economic crashes, and even near bankruptcy in the early 1990s. If any car company seemed too strong to fail, Porsche was it. Then came the bet that changed everything. In 2020, Porsche launched the Taycan, its first fully electric car. This wasn't meant to be a small experiment. Porsche wanted to prove it could dominate luxury electric cars, just as it had dominated sports cars for decades. Then CEO Oliver Blume made the goal clear. By 2030, 80% of Porsche's sales would come from electric or hybrid vehicles. The Cayenne, Macan, Panamera, and 718 were all heading toward electrification. Only the 911 was expected to remain Porsche's gasoline-powered icon. The company poured billions into electric factories and technology. It also partnered with Swedish battery company Northvolt to secure batteries for its future electric lineup. At first, the strategy looked brilliant. The Taycan won awards and reached more than 41,000 sales in 2021. For a luxury sedan starting above $90,000, those numbers were impressive. Porsche seemed to have solved the problem that many traditional automakers were struggling with. Then, China changed the game. By 2021, China had become Porsche's biggest market, accounting for nearly a third of its global sales. 96,000 Porsches were sold there in a single year. Then demand began collapsing. Chinese manufacturers such as BYD, NIO, and Xiaomi started producing electric vehicles that were cheaper, technologically advanced, and designed around what younger Chinese buyers actually wanted. Xiaomi was especially shocking. A company known for smartphones entered the car business with the SU7 and sold more than 100,000 units in a year. It even recorded a faster lap around a Shanghai circuit than the Taycan. And that exposed Porsche's biggest problem. Its heritage wasn't enough. The average Chinese EV buyer is much younger and often cares more about software, screens, charging speed, connectivity, and driver assistance than decades of racing history. Porsche had the badge, Chinese automakers had the technology and price. Then the Taycan developed another problem: its reputation. Consumer Reports ranked it among the least reliable vehicles of 2023. Owners reported warning lights, system failures, and battery issues. The car was hit with multiple recalls, while replacement parts were sometimes difficult to obtain. But reliability wasn't the only issue. The numbers simply didn't make sense. A base Taycan cost close to $90,000 and offered roughly 310 kilometers of range. A Tesla Model S could travel nearly twice as far. The comparison became even worse at the top end. The Taycan Turbo S approached $190,000 while offering similar range. A Tesla Model S Plaid cost far less, traveled much farther, and could accelerate even quicker. Porsche had built an expensive EV in a market that was rapidly becoming obsessed with value and technology. So the company did something almost unthinkable. It started cutting prices. Some Taycan models were discounted as much as 35%. Even the legendary 911 received discounts of more than 10% in some markets. And that created a dangerous problem. Porsche wasn't just selling cars cheaper, it was weakening the belief that a Porsche should never need a discount. By May 2024, the situation in China had become so bad that some dealers were refusing additional factory shipments while struggling with unsold inventory. Then another piece of Porsche's EV strategy collapsed. In November 2024, Northvolt filed for bankruptcy. The battery supplier Porsche had counted on for its electric future was suddenly gone. The damage spread quickly. The next-generation electric Boxster was pushed from its expected 2025 launch to at least 2027. Then, in August 2025, Porsche shut down its own battery production operation, cut around 200 jobs, and wrote off roughly 400 million euros. The electric Macan wasn't doing much better. Software problems delayed its launch, and during its first partial year, sales were only around 18,000 units. It also cost about $30,000 more than the previous gasoline model, making the transition even harder to justify. Inside Porsche, the pressure was becoming impossible to hide. In February 2025, Porsche removed its CFO and sales chief after they publicly disagreed with CEO Oliver Blume. At the same time, the company's profit outlook kept getting worse. The operating margin forecast fell to 6.5 to 8.5% in April, and then collapsed again to just 0 to 2% by October. And then Porsche quietly abandoned the target that had defined its EV strategy. The famous promise that 80% of Porsche sales would be electric or hybrid by 2030 was gone. Instead, Porsche simply said it would continue offering gasoline, hybrid, and electric vehicles. The grand EV plan had become a much more cautious survival strategy. In July 2025, a leaked letter to around 36,700 German employees revealed just how serious things had become. Blume admitted that Chinese sales had fallen to historic lows. EV margins were far below gasoline models, while American tariffs were creating even more pressure. Porsche's original business plan simply wasn't working in the new market. The company responded with 3,900 planned job cuts through 2029 and announced a permanent production ceiling of about 250,000 vehicles per year. That was roughly 20% below previous levels. Taycan production was also reduced from 2 shifts to just 1. Porsche had finally admitted it needed to shrink. But even that wasn't enough. Only 3 months later, the board removed Oliver Blume as Porsche's CEO. Blume had spent years leading Porsche while also running Volkswagen, and investors had become increasingly frustrated with the divided leadership. During his tenure, Volkswagen's stock had fallen nearly 30%, while Porsche's share price had roughly been cut in half since its 2022 IPO. Then came the next chapter. In October 2025, Porsche announced that it was negotiating with former McLaren chief Michael Leiters to become its new CEO. Leiters wasn't a stranger to Porsche. He had previously spent 13 years working at the company and also had experience at Ferrari and McLaren. He officially took over on January 1, 2026. And he inherited something far more difficult than a struggling car company. He inherited a Porsche that spent billions betting on the future, only to discover that the future had changed before it arrived. And now, the question wasn't whether Porsche could build another great car. It was whether Porsche could rebuild the strategy that made it great in the first place. Porsche was supposed to be one of the biggest winners of the electric car revolution. Instead, the company is now cutting jobs, delaying EVs, changing major vehicle programs, and quietly moving away from the strategy it once promised the world. And the numbers explain why. On March 11, 2026, Porsche released its full 2025 financial results. For new CEO Lutz Meschke, the first major earnings presentation of his tenure came with some painful figures. Porsche's operating profit collapsed to just $413 million. That was a staggering 93% drop from the previous year's $5.6 billion. The operational division performed even worse, earning only $9 million, a 98% decline. Revenue fell 9.5% to $36.27 billion, while profit after tax plunged 91% to just $310 million. And then there was the Taycan. The EV that was once supposed to prove Porsche could compete at the highest level of the electric market sold only 16,339 units during the year. That was more than 60% below its 2021 peak of 41,296. Porsche's new strategy was summed up in 3 simple words: leaner, faster, desirable. But hidden inside its 2026 outlook was an even bigger warning. Porsche had once promised that 80% of its sales would be electric by 2030. Now the company was targeting just 24 to 26%. That wasn't a small adjustment. It was a dramatic retreat from the future Porsche had spent years promising. And the retreat didn't stop there. Reports in early 2026 revealed that Porsche's massive K1 SUV was being reworked. The K1 had originally been designed as a major all-electric statement built around Volkswagen Group's dedicated EV architecture. Now, Porsche was reportedly shifting the vehicle toward Audi's combustion engine platform. That means the SUV could share its foundations with the upcoming Audi Q9 and use turbocharged V6 and V8 engines. The vehicle that was supposed to demonstrate Porsche's ability to go fully electric at the top end of its lineup was suddenly being designed around gasoline power. Then came another reversal. Porsche also began backing away from its electric-only plans for the next-generation Boxster and Cayman. Instead of becoming purely electric sports cars, the new models are expected to keep combustion engine options alive. And then came the announcement that pushed everything over the edge. On July 22, 2026, Porsche's supervisory board approved another major restructuring program, and this one is massive. The company is preparing to eliminate another 5,000 to 6,000 jobs by 2035. That's on top of the roughly 3,900 positions already targeted under the previous restructuring plan. At the same time, Porsche's electric Panamera has reportedly been pushed far into the next decade, with no firm launch date currently attached. Even Porsche's connection to Volkswagen Group's software partnership with Rivian seems to be weakening, removing another important link to the company's previous electric-first strategy.
A new production chief is also expected to take over in September. And according to one developer quoted anonymously in the German press, walking through Porsche's Zuffenhausen facilities today feels like watching the company reverse an entire decade of strategy. But here's why this matters, even if you never plan to buy a Porsche. Porsche was supposed to be the perfect test case for the EV transition. It had enormous financial resources. It had decades of engineering experience. It had one of the strongest automotive brands in the world, and it had the performance credentials to charge premium prices. If any traditional automaker seemed capable of making the electric transition work, Porsche was one of the obvious candidates. But instead of getting one clean transition, Porsche has now been forced into a second major retreat. The first came in 2025, when the company abandoned its 80% EV target. Now, under a new CEO and a new strategy, the company is cutting even more jobs and rethinking some of its biggest electric projects. And that creates a much bigger problem for the rest of the industry, because executives at BMW, Mercedes, Audi, and even American automakers are watching closely. They're asking a very uncomfortable question. If Porsche couldn't make it work with all of those advantages, what makes us different? And there's another lesson here that may be even more important. Porsche didn't simply invest in electric vehicles. It built an enormous amount of its future around a specific timeline. The company expected customers to move toward EVs quickly. But when demand failed to grow at the expected speed, some of those investments became expensive liabilities. Factories had been prepared for an electric future. Vehicle programs had been designed around EV platforms. Suppliers had been selected based on that strategy. And suddenly, the customer Porsche expected wasn't there in large enough numbers. That is why automakers taking a mixed approach to gasoline, hybrids, and EVs currently have an advantage. They don't necessarily know which technology will ultimately win, but they also haven't bet everything on one answer. And that brings us to the real problem facing Porsche. This isn't simply a story about the Taycan being unpopular. The Taycan is still widely regarded as an excellent driving EV. The problem is bigger than one vehicle. Porsche discovered that engineering excellence alone isn't enough. A powerful brand doesn't automatically solve charging problems. Heritage doesn't close the software gap. And decades of racing success don't guarantee that customers will accept a new technology at a premium price. Porsche now appears caught between two very different customers. Traditional Porsche buyers still want the sound, feel, and character of a combustion engine. But EV buyers increasingly expect cutting-edge software, fast charging, long range, and technology that can compete with the best companies in the world. Porsche has to satisfy both groups, and right now, that is proving extremely difficult. Its traditional cars can be expensive for some buyers, while its EV products can feel behind the technological curve for others. That's the trap Porsche is trying to escape, and nobody, including its new leadership, appears to have a simple solution yet. That is why Porsche's latest restructuring matters far beyond Stuttgart. The company was supposed to become the example that proved traditional luxury automakers could successfully dominate the electric era. Instead, it may become something very different, a warning. Because if Porsche, with its money, engineering talent, reputation, and decades of experience, can be forced to rethink the EV strategy this dramatically, every major automaker has to take notice. The question is no longer whether the electric transition will change the auto industry. It already has. The bigger question is which companies will adapt quickly enough without destroying what made them successful in the first place. So what do you think? Is this the reset Porsche needs to finally get its strategy right? Or is the company simply cutting its way through a problem that keeps getting bigger? Let me know in the comments. And if you're new here, this channel follows the engineering, history, business battles, and decisions shaping the cars that eventually reach your driveway. No brand gets a free pass. We simply follow the story wherever it leads. Subscribe if you want to see where Porsche goes from here, because this story is far from over.